welcome back for the final episode in our Ultimate Lease Accounting series. So our last video, we defined lease modifications, discussed the differences between a lease modification and a lease reassessment, and then walked through a modification example. We will terminate our Ultimate Lease Accounting series by defining full and partial lease terminations, and then going through an example of how to account for a partial termination. Let's begin. A termination is reduction of the rights to the asset originally outlined in the contract. Terminations are divided into full or partial terminations based on how much of the asset is reduced. If the lessee's rights to the underlying assets are reduced to zero or nothing, this is a full termination, and the accounting is to reduce the lease liability and right of use asset to zero as of the termination date. If there is a difference in the amount of the lease liability or right of use asset, that difference is recognized as a gain/loss on the income statement. If the termination is a partial termination, for example, the lessee is leasing 9,000 square feet of an office building, and then sometime into the lease, they sign an agreement with the landlord to only lease 6,000 square feet, the amended agreement would result in a partial termination of the existing lease arrangement. A partial termination is accounted for like a lease modification. The lease is reassessed and remeasured using the modified contract terms. And that's what we'll spend the rest of this video going over. When accounting for a partial termination, and this is going to be a reduction in the asset's rights, not just a reduction in the lease term, there are 3 required steps. First, reassess the lease classification using the new modified contract terms. Second, remeasure the lease liability, again, using those new modified contract terms. And then lastly, remeasure the right of use asset. However, this time it's going to be based on the proportionate reduction of the lessee's rights to the underlying asset. The first step is to reassess the lease classification of the modified contract. This is done by reviewing the same criteria for finance and operating leases used in the initial classification test. If any of these criteria exist, then the lease is a financing lease. Again, criteria number 5 is new for ASC 842. The second step is to remeasure the lease liability. The lease liability should always equal the present value of the remaining lease payments. To remeasure the lease liability for a partial termination, calculate the present value of the remaining modified lease payments using the discount rate in effect as of the date of the partial termination. The third step required is to remeasure the right of use asset so that the modified asset is reduced in proportion to the partial termination of the lease. The right of use asset is reduced to represent the decreased rights to the underlying asset. Under ASC 842, 2 different approaches for reducing the right of use asset are allowed. The first one is to calculate the new right of use asset using the proportionate change in the lease liability, and the second one is to calculate the new right of use asset using the proportionate change in the right of use asset itself. The first option calculates the remaining right of use asset using the proportionate change in the lease liability. So after you have determined the new lease liability as the present value of the remaining lease payments, calculate the reduction in the lease liability as a percentage change by comparing it to the lease liability balance directly before the remeasurement. Then calculate the corresponding reduction in the right of use asset by multiplying the right of use asset balance directly before the remeasurement by the percentage change that you calculated from the lease liability. You now have the lease liability reduction amount and the right of use asset reduction amount. As with a full termination, any difference between these two is a gain or loss recognized on the income statement. You see this in step 4. So then the journal entry for the partial termination is a credit to the right of use asset, a debit to the lease liability, and a debit or credit to gain or loss on the income statement. The second option calculates the modified right of use asset using the proportionate change in the right of use. The steps are similar, But when you're calculating the percentage change of the right of use asset, you look at the reduction of the size of the asset, meaning the number of floors or the square footage, whatever is an appropriate representation of the reduction of the asset. So the percentage change in the right of use asset is applied to the carrying amount of the right of use asset balance directly before the partial termination to determine the reduction amount of that right of use asset. And then the remaining right of use asset for this approach is calculated based on the proportionate change in the right of use asset, but the remaining lease liability will always be equal to the present value of the remaining modified lease payments. So again, for this approach, the difference between the reduction of the right of use asset and the reduction in the lease liability is going to be a gain or loss recognized on the income statement. And then lastly, just a couple of things to consider. Under US GAAP, a company is able to use either approach, but what you want to make sure to think about is, one, if you report under US GAAP and IFRS, the IASB only allows the second approach to be used. Two, if you are charged a large penalty for the termination, this might skew the results when you use the proportionate change in the lease liability method. And then finally, the approach you use is looked at as a policy election and therefore should be applied consistently to similar types of transactions, not handpicked based on what results you want returned. So now let's walk through example 10 from the Ultimate Lease Accounting Guide to illustrate the difference between the two approaches. Here are the assumptions for the original lease. Tenant Co. will lease 5 floors of a building of office space for $3 million per year with 2% increases over a period of 2 years. And then they have an IBR of 5% that they're going to use. So the present value of those payments is going to be $26,422,533. So here is an amortization table for the original lease. And we're going to say the modifications were made in the 6th year. So in that 6th year, you'll note that we have a liability balance at the end of the 6th year of $12,945,733, and the right of use asset balance at the end of that 6th year is $12,160,598. So the modifications that we'll use, the lease agreement is going to be modified to be 3 floors instead of 5, beginning 2028. The payments are now going to be $2 million annually, still with the 3% escalation. First, Tenant Co. is going to reassess the lease classification, and it's going to determine that it's still an operating lease. Then next, the lease liability is going to be remeasured by taking the present value of the modified lease payments using the discount rate as of the modification date. So using these assumptions, the new lease liability calculates to $7,829,394, which then results in a decrease of $5,116,339 from that original lease liability balance of $12,945,000. So here are the steps for the first approach. Step 1, you take the reduction of the lease liability, this $5 million, and calculate it as a percentage, which the percentage change is going to be 39.52%. Apply that percentage change to the right of use asset balance directly before the modification to get the calculated amount of the right of use asset reduction. Then you take that reduction amount and subtract it from the right of use asset balance directly before the modification and get a new right of use asset balance. Lastly, step 4, you take the reduction of the lease liability from up here, the 5 million, compare it to the calculated reduction in the right of use asset, the 4.8. That difference is 310,296. You have all the numbers for the journal entry now. You have a reduction in the lease liability of 5,116,000. That comes from this step here. And then you have a reduction in the right of use asset of 4,806,000. That number comes from here. And then lastly, the difference between those two here is a gain on the termination, which you calculated in step 4 here. And then here is what the amortization table would look like after the reduction adjustments have been made. Again, we stopped at the end of 2027. This is the amendment amount that we calculated. These are the new balances and the amortization table through the end of the lease. Now here's the calculation of the right of use asset using approach 2, the proportionate change in the right of use asset. Step 1 is to calculate the percent change in the size of the right of use asset. Here we're assuming the floors are all comparable in square footage, so using the number of floors for the change. We go from 5 square feet to 3, so that's a reduction of 40%. Step 2, apply the percentage to the right of use asset amount directly before the modification to calculate the reduction in the right of use asset. Step 3, we're going to calculate the proportionate change in the lease liability to get the proportionate reduction in the lease liability. Then in step 4, we compare that proportionate reduction of the lease liability, the 5,178,000, to the calculated right of use asset reduction amount, which is that 4,864. You can see that here. And the difference between those two is, again, a gain on partial termination. So that's the 314,054. So we've calculated all of those amounts, and we can now book the journal entry. So note here in approach 2, we're using the same reduction amount in the lease liability from approach 1. The gain is going to be the gain calculated from comparing the calculated proportionate change in the lease liability with the calculated change in the right of use asset. Then the right of use asset reduction is the difference between those two amounts and not the amount calculated in step 2. And finally, the change amounts we calculated are used to reduce the lease liability and the right of use asset, and the new amortization table is created. So that walks you through the 2 different approaches to calculating the change in the right of use asset.